So guys, so let's go over the stock market very quick for today. So a few things has happened. I don't know if you were following the news since last night, Sunday, in the evening. A lot of people stopped buying GameStop, the GME, because of the tweet by the Roaring Kitty. He was going extremely bullish. He was buying a lot of calls, millions of dollars worth of contracting calls. And then when the news came out, everyone stopped buying. So what happened was, as the market opens on Monday, so this is on Friday, right? So the market closes around 23. And then look what happens. So this is a 30-minute chart. Let's go to the 5 minutes. I want to show you the massive gap up. So as the market opens, GME is at $40.50 or whatever. So this is the beginning, the first 5 minutes. And then look at the drop here from 40 all the way down to $27, $28 within the first perhaps 30-40 minutes. It's a massive drop. So I want to say it's about more than 10%. So $10, $12 actually out of 40, it would be 1/4, so about 20% drop. So it's huge. And then you might think, well, what if I bought puts? Like, let's say, let's play it. Let's go back in time. Let's say you caught the market at the right time, perfect time if you were lucky, and you start buying puts right off the bat. So let's go here. I'm gonna show you. I'm using a Robinhood, the option chain, to show you how much you could have made. So you start at 325, which means one contract will cost you $300, and then it goes up to 500, and then the max is around 7:10 a.m., which is 10:10 actually in New York, because I'm having a Pacific time zone. So it would be $620, so less than a double. So, but the problem is, because of the IV, the implied volatility, look, it's like 450%. Because of that, even though it drops like massively, like it drops by 20%, the stock alone. If it was like a other stock, like for example, if it was a SPY dropping that much, you would have made 2000% or something. Versus here, you probably make 150, 200%. So the issue is, even if you got it at the right time, you still wouldn't have made money. I personally don't trade the first 30 minutes of the day. I wait until 7 or 7:10. So if you got in around that time, you basically wouldn't have made any money, because the first 30 minutes is extremely volatile. So even if you cut the right direction, you would barely make any money. It wouldn't have worth the risk. And then if you went with calls, let's take a look. Let's say if you bought it Monday morning when the market opens, since market is closed basically on the weekend. So if you went with the $40 call, $40 strike price call, expiring in Friday, about 4 days away, 5 days away to expiry. So the cost of the one contract is $7, so which is $700, because it's multiplied by 100, right? So you pay $700, and then the moment you buy, the first 5 minutes, it doesn't go any higher, and then boom, drops all the way down to 268. So you would have lost about 60-70% of your money if you went with the call. That's why it's so risky doing the GME during these type of time going based off the news, like especially overnight when the news comes, and by the time people stop buying the next day, the market just crashes. Even the news is bullish technically. And then even if you go with the put, you still wouldn't have made that much, because of the IV, the implied volatility is so high, and the market goes against the bulls, against the news. There is not much room just to be, just to make profit. So I didn't trade it, and I'm glad I didn't, because either way you couldn't have made that much money. The only time you could actually have made money if you were swing. So let's take a look at if you went with calls, for example. Let's take a look at the calls, how much it was last week. So on May 31st, which was, I believe, Thursday, I want to say. Let's take a look. 31st was actually no, Friday. So on Friday, the same contract will cost you $35. So 35 cents or $35. It will go up first in the morning. It would have been around $600. So now that's about 20x or 2000% return. That would have made you a lot of money if you bought it on Friday. However, let's take a look at the chart on Friday. If you go with the 5-minute chart, you see there is not much volume, no volatility. So it would have been very hard to predict unless you have a knowledge of the future. So as you see here, yeah, it would be very difficult to predict these things, especially after a massive drop. So 64, that was a couple of weeks ago when the first news came after the tweet from the Roaring Kitty. So yeah, after that, after this huge drop, so the market goes sideways for a while, and then we have some volume on Tuesday, May 28th, and then on Friday, of course, the market closes around 23, and then huge gap up. But yeah, as I said, you could have not be able to possibly predict this unless you were one of the whales, like the guy who bought multi-million-dollar worth of contract of calls. So yeah, it would have been very difficult to predict this, but that's the only time you could have made a very good amount of return, is if you did a swing. So yeah, that's that. And then as far as the SPY goes, let's take a look. So we're on the 30-minute chart. So SPY up to here, it was going sideways, and then it broke the support right here. So we had the support at 524, it broke it, went down all the way to 518, and then a massive bounce back. So this is on Friday, I want to say, yes. So this is Friday. You see like huge volume comes in. So it bounces back from 518, goes all the way to 527, it closes, and then on Monday it gaps over slightly, go to 529 before it crashes again back to 523. So it's like a huge drop, and then we have a bounce back, but it's not like fully recovered. See 529, and it closes around 527, 528 perhaps. So but if you went with the calls, because of the implied volatility, if you bought it at the open, you would have lost money, maybe 30-40% of your value, because of the implied volatility, and also the theta. As the time goes up, the value of your contract goes down. So the only time you would have made money if you waited until midday. So that's the only time, around this time. So it will be around 12:30, which is 3:30 in New York time. Actually, no, this is correct. No, this is based on the New York time. My bad. So this is like 12:30 New York time, 5:23. So it would have given you a decent amount of return if you bought it right at this time. But anything beside that, if you were bullish on a SPY, you would have lost money. So it seems like at this moment, if you're doing trading with the SPY, either you want to do a scalp or you want to wait until it drops if you're going bullish before bouncing back. That's when you actually make the profit. Or in this case, if you have gone with the put, you could have made a decent return from 529 when it goes to 523. So yeah, if you bought any contract like 525, 527, you could have got a pretty decent return on your contract if you were with the puts. But overall, it seems like, let's take a look at the 1-day chart, and I want to see. So it seems like this is still bullish. However, it has its up and downs. So anytime it goes to an all-time high, it does a quick pullback. And if you're doing swing, you probably don't want to do puts, because we are still in the upward momentum, so it will be very difficult to make money with the puts. If you're doing day trade or intraday trade, there is still a chance you could have made money. But yeah, it would overall, like, the market is still, it seems like it's bullish, at least with the S&P 500 and most of the tech stocks. They are still in the upward momentum. However, you cannot be always 100% sure. The market could change at any time, especially when you look at the candles like this. It's still red, but it drops, and then when it comes back, you see a wick, a massive wick right here. That means there's still a lot of buyers coming in. So that's that. So hope you enjoyed it, and make sure you like and subscribe, and I'll see you in the next video. Cheers.